This afternoon at 2:30, the Reserve Bank of Australia handed down its August decision, and for the second meeting in a row, it held the cash rate steady at 4.35%. No rise, no cut. If you've got a mortgage, your repayments don't change again. After 3 rate rises earlier this year, that's a relief. But here's the thing you need to understand before you breathe out. A hold is not a turning point. The RBA has held, yes, but the language it used and what it means for when relief actually arrives is the real story. Today, we're breaking down what happened, why, and what it means for your money. Let's start with how we got here, because this year has been a roller coaster for anyone with a home loan. Coming into 2026, rates were at 360%. Then the RBA raised 3 times in a row, February, March, and May, taking the cash rate to 4.35%. That was driven by inflation, which surged largely because of the fuel price shock from the Iran war and the disruption to Middle East oil supply. Every one of those rises got passed straight through to mortgage holders. Then in June, the RBA paused. And today, it paused again, holding at 4.35% for a second straight meeting. So the cash rate has now been steady since June. The reason the RBA felt able to hold comes down to one number, released on July 30th. The June quarter inflation figures. Headline inflation eased to 3.8%, and the core measure, the trimmed mean, which the RBA watches most closely, stopped climbing at 3.6%. That was softer than expected, and it was enough to take another rate rise off the table for August. Every one of the 37 economists in a Reuters poll expected today's hold. It was about as certain as these things get. So that's the good news. Now here's the fine print, and it matters. What the RBA does with the rate is only half the story. The other half is the language it uses in its statement, because that language signals what's coming next. And the phrase everyone was watching for was whether the RBA kept its warning, that it would raise rates further if required. This is what's called a hawkish hold. The RBA holds the rate steady, but keeps the door firmly open to more hikes. It's the central bank saying we're pausing, but don't mistake this for the end. We're still watching inflation, and if it flares up again, we'll act. Governor Michelle Bullock made this clear back in June, describing the pause as exactly that, a pause, not a pivot. And the trimmed mean inflation rate of 3.6% is still above the RBA's target band of 2 to 3%. So even though inflation has softened, it hasn't softened enough for the RBA to relax. The job isn't done. The practical takeaway today's hold is not the beginning of rate cuts. It's a plateau. Rates are sitting high, and they're likely to stay high for a while yet. So when do rate cuts actually come? This is what every mortgage holder really wants to know. The consensus among the major banks is sobering. Commonwealth Bank expects the RBA to hold rates through the rest of 2026. The broader market consensus now sees no rate cut before 2027. Read that again. Most economists don't expect any relief on rates until next year at the earliest. There's a reason for that caution, and it has a name: the Middle East. The single biggest wildcard for Australian inflation remains oil prices. The Iran conflict has kept oil elevated, and Australia imports almost all its refined fuel, so we're heavily exposed. Commonwealth Bank specifically flagged that a renewed escalation in the Middle East could push businesses to pass on higher costs and reignite inflation. If that happens, rate cuts get pushed even further away, and a rise could even come back onto the table. Morgan Stanley analysts went further, saying they expect the RBA's own forecast to show inflation not returning to the middle of the target band until 2028. A large minimum wage increase in July, a weaker Australian dollar, and higher fuel costs are all keeping inflationary pressure alive, even as consumer demand softens. So what should you actually do with all this? Here's the practical part. First, don't budget around rate cuts arriving soon. If you've been holding on, telling yourself relief is just around the corner, the honest message from today is it's not. Plan your household finances on the assumption that rates stay near 4.35% well into 2027. Treat any earlier cut as a bonus, not a plan. Second, this is the big one: don't wait for the RBA to save you. Your lender doesn't have to wait for the RBA to change your rate. Right now, with rates on a plateau, banks are competing hard for good borrowers. There are lenders offering variable rates below 6%. If you're paying more than that, pick up the phone. Ask your bank what they'd offer a new customer and ask them to match it. Or get a broker to shop your loan around. In a flat rate environment like this, negotiating your own rate can save you far more than waiting for the RBA ever will. Third, if your mortgage pre-approval was issued a few months ago, check its shelf life. Most run 90 days. If yours was assessed back in May or June at current rates, It's still valid through a hold like today's. But if it's about to expire, start the renewal now, while you know what the assessment rate is. Fourth, get both fixed and variable pricing in writing this week. Fixed rates move on expectations, not on the RBA's actual decision. They price off the language in the statement. So if today's statement was read by markets as leaving the door open to hikes, fixed rates might not fall much. Compare your options with real numbers, not assumptions. Here's the bigger picture to sit with. Australia's mortgage holders have been through a brutal few years. From near zero rates in 2020 to 4.35% now. Repayments up by more than $1,000 a month on a typical loan compared to a few years ago. And today's message is that this high plateau is where we're staying for a while. Stability, but no relief. The cost of living squeeze that's dominated this channel housing, groceries, fuel, rates isn't easing yet. Today's hold prevents things getting worse on the mortgage front, but it doesn't make them better. And the path to genuine relief runs through inflation coming down, which runs through the fuel situation stabilizing, which runs through a Middle East conflict that remains stubbornly unresolved. So a hold. Welcome, but not a turning point. Rates are high, and they're staying high. The best thing you can do isn't to wait. It's to take control of the one number you actually can influence, which is the rate your own bank charges you. Are you a mortgage holder? Has the hold given you any breathing room? Or does it just feel like being stuck at a high plateau? And have you tried negotiating with your lender? Drop it in the comments. Practical experiences here genuinely help other people watching. Like and subscribe for more Australian news explained simply. See you next time.